Financial markets in Tokyo have dropped to their lowest level since 2014 because of concerns about the health of the global economy. Concerns about the fortunes of big banks have hammered shares globally in recent days following the adoption of negative interest rates. Meanwhile, Australian markets closed down more than 20% since their peak last year. For more on what's happening in the global economy, I'm joined by Simon Smith in London. He's the chief economist with FX Pro Group. Simon, thanks for your time there. Now, what is going on in the banking sector which has everyone so worried?
A number of factors have combined together, I think, this year. If you look in Europe, the banking sectors are down around sort of 25% on the Euro stocks. What's happening is the number of factors, as I said, concerns about the global economy, the move to negative interest rates in Japan hasn't helped, speculation that the European Central Bank may move their deposit rate more in negative territory. And that doesn't really work well for the banking sector. The banking sector is based on, you pay interest if you borrow money, and if you lend it out, you receive interest. So we've turned everything around. That's combined with the fact that quantitative easing has ended in America, rates are going up. And asset markets themselves have become very inflated by quantitative easing itself. So the whole model on which banking is based, i.e. borrowing or taking in deposits, short-term deposits, lending through various means on long-term and less liquid assets, is in itself quite fragile, but I think even more fragile in the environment we're seeing at the moment.
And all eyes are on the US Federal Reserve Chair Janet Yellen's testimony in Congress. What will she have to say, and will it be enough to calm the volatile global economy?
I think she's struggled to sort of calm markets at this point in time. Previously, when we're in periods of quantitative easing, bad news used to be good news, and that was the way markets went. So if she was sort of bearish, markets would then expect more quantitative easing. That would in itself bring expectations that equitism would be buoyed higher. We're not in that world anymore. We're in a world where the Fed has already started to put up rates in December. So that dynamic has changed. So we can't no longer see bad news as good news. But even good news, i.e. she's more bullish on the economy, I think will be taken with some speculation, because naturally the market has priced out the chance of Fed easing pretty much for the rest of the year. So the best she can do is really acknowledge the deteriorating global environment, remain modestly bullish on the US economy and its ability to ride that out. But I'm not necessarily sure that's going to be enough to put long-lasting stability into markets.
And the German government has insisted that the Deutsche Bank is, quote, rock solid. But do you think that when the government makes a point to reassure people in that way, is that the best sign that perhaps it actually isn't rock solid?
Governments always tread a very fine line in these situations, because even acknowledging that there is perhaps some concerns, and there then can reiterate those concerns. If you look at the metrics on Deutsche, it's well capitalised, its capital ratios are in line with industry averages, not better. But the recent push down in the share price means its sort of price to book ratio is substantially lower, around sort of 30, 32, 33. 0.33. The industry is around twice that. So, on that basis, it does look like Deutsche Bank has taken a relatively more of a beating than other banks, and the capital ratios are indicative of a bank that is well capitalised, as many banks are now in relation to 5 to 7 years ago. So I think it was a sort of calculated move on the part of the German government to try and draw a line under the pressure that Deutsche Bank has been put under. But I think it's probably too early to say that we're out of the woods yet. So on balance, yes, on paper, things look okay. But as always, banks are down to investor confidence. And if that gets lost, then things can turn around very quickly.
OK. All right. Thanks. We'll leave it there, Simon.